Hey folks, welcome to a product review at Finominal. Today we're going to look at some of the largest ETFs that are managed by the most well-known financial influencers in the US. Specifically, we're going to look at the ARK Innovation ETF, which is managed by Kathy Wood, at Tom Lee's Fundstrat GRNY ETFs, Dan Ives Wedbush AI Revolution ETF, and the advisor shares Gerber and Kawasaki ETF. Now, let's investigate in terms of how similar and how different these four ETFs are. And of course, if they have created value for their shareholders. Now, we're going to kick off with an analysis of the underlying portfolios. And given that these ETFs effectively provide access to the best ideas of these financial influencers, we do see very concentrated stock portfolios. So we can see the number of stocks in the portfolios range from 32 to 51 stocks. We can also see that the overlap between these ETFs is fairly low. I think the highest overlap is actually the Gerber Kawasaki ETF with the S&P 500, 34.87%, but that is still very low. And that, of course, is explained by the concentrated stock portfolios, where the overlap of stocks remains on the lower side. If we do look at the top 10 stocks across these four ETFs, we do see the number one holding is Tesla, followed by Broadcom and by NVIDIA. We can switch the perspective to seeing from a fundamental perspective in terms of what's in these portfolios. It's all equities. There is hardly any international exposure, so it's primarily US equities. But we do see significant discrepancies if you look at breakdown by sectors. And the one sector that kind of stands out is the technology sector, where the ETF from Dan Ives has an 84% allocation, as expected, right, for an AI Revolution ETF, compared to more like 40 to 50% for the other ETFs and 47% for the S&P 500. We also see some more over and underweights. We see that ARK and the GRNY short ETFs have overweights in financials, at least compared to the S&P 500. And we also see that ARK has an overweight in healthcare stocks with 26%. The ETF that is most similar to the ETF, as we've seen in the overlap analysis, is the Gerber and Kawasaki ETF, right? Now, that's from a sectoral perspective. If we move from sector to factors, we can look at the current portfolios and how the stocks within these portfolios compare to the S&P 500. Now, there are some similarities of these four ETFs. So, for example, we can see from a valuation perspective, all four ETFs have stocks that are more expensive than the average stock in the S&P 500. We can also see that all ETFs have stocks that are more volatile and have been more outperforming than the average stock in the S&P 500. Having said that, if we look at growth or even quality, there we do see meaningful differences. And the one ETF that kind of like differentiates itself probably most is ARK. So ARK, for example, has stocks that are lowly levered, but also very low from a profitability perspective, and quite low in terms of earnings growth. And we can probably explain that by the overweight in healthcare stocks, because that probably includes a lot of biotech stocks that are, well, long and very speculative bets on the future. Now, moving to performance, there's actually not so much to say. The problem is, of course, that two of these ETFs, the one from the GRNY Shots ETF as well as one from Dan Ives, they've only been listed in the last 1 or 2 years. So we only have about 6 months or so where we can look at the performance over the last 6 months, right? I think all of those four ETFs kind of like, or three of the ETFs achieved higher returns than the S&P 500. Having said that, they were also much more volatile. So we can see that even over this very short time period, we can see the volatility of ARK, 35%. The other ones are 17%, 22, and 15% are much higher than the volatility of the S&P 500. And that's kind of like easy to reconcile because the portfolios are more concentrated. And if you have more concentrated portfolios, that implies high volatility. Now that also reflects that some of those ETFs have achieved higher returns than the S&P 500, but not higher risk-adjusted returns. So if you look at the Sharpe ratio, actually none of the 4 ETFs, right, has a higher Sharpe ratio over the last 6 months than the S&P 500. But as discussed earlier, we need to discount performance stats because 6 months is not meaningful. Having said that, we can look at the one ETF that has the longest history, which is the ARK Innovation ETF. And well, this is very well known that ARK had a significant outperformance leading up to 2021, then a brutal underperformance, right, with an 80% drawdown. And so now if you look at the long-term performance, well, it's almost identical performance compared to the S&P 500. Having said that, naturally at much higher volatility, right, and much less pleasant investor journey, so the Sharpe ratio is less than half of that of the S&P 500. And that kind of is characteristic, unfortunately, for most of these thematic ETFs, where either you have a portfolio that has themes that are very compelling, invest in AI, invest in cybersecurity, invest in EM excluding China, anything like that, or where you have a very persuasive fund manager, which you have in the case of these ETFs. Unfortunately, right, you can also characterize this as performance chasing with a narrative. And usually what happens is that most investors allocate to these ETFs when they are at their peak, like you can see here with ARK. But it's very difficult to generate outperformance like that, and they tend to disappoint investors over the long term. Hope that helps. Have a nice day.